Welcome to vTalkInsight Market Drivers Daily for January 22nd, 2026. Geopolitics, artificial intelligence, and a surprisingly strong U.S. economy are pulling markets in different directions today, and how those forces resolve will matter for risk, returns, and volatility across portfolios. Geopolitics remains the central market driver, with the Arctic and Greenland now tightly woven into a broader tariff and security story that is unsettling risk assets. The United States is signaling that control over Greenland is a strategic priority, tying its importance to missile defense and critical minerals, and even floating tariffs of 10 to 25% on countries sending troops there. European leaders respond by threatening countermeasures and deploying new trade defense tools, while the European Parliament has put work on the EU-US trade deal on ice, reinforcing the sense that the post-war economic order is fraying rather than healing. At the same time, defense spending is being reset higher almost everywhere, adding a structural layer to this shift. NATO members are reported to be moving from the old 2% of GDP guideline towards something closer to 5%. Canada is earmarking about $80 billion for defense with a focus on the Arctic, and Germany is lifting both defense and infrastructure outlays that are expected to nudge its growth rate higher in coming years. On the U.S. side, a military budget described around $1.5 trillion and new security framework for the Arctic underscore that hard power is back at the center of policy, while talk of a Trans-Pacific Partnership alignment with Europe hints at trading blocs hardening into rival camps. Markets are reacting in classic risk-off fashion, but with some nuance. We have seen sharp equity pullbacks, including a notable drop in the S&P 500, a double-digit intraday fall in Bitcoin, and a larger slide in Ether, while gold and silver keep pushing to fresh all-time highs despite a firm dollar, signaling intense demand for perceived safe havens. Some observers argue that only a deeper correction, perhaps on the order of 10 to 20%, will force policymakers to seek real compromise on tariffs and security disputes, which keeps a volatility premium embedded in risk assets. Yet this is not a one-way escalation story. There are credible off-ramps that could flip sentiment quickly. Analysts see a reasonable chance that the U.S. president will use high-profile speeches and bilateral meetings with European leaders to soften rhetoric on Greenland and tariffs, and some assign greater odds to the escalation rather than escalation from here. Peace negotiations on Ukraine are said to be largely drafted, with claims that a deal is mostly complete, and if stability takes hold, projections suggest Ukraine's GDP could potentially triple over a decade, opening a massive reconstruction and investment theme across infrastructure, energy, and rare earth supply chains. More broadly, the old global order anchored by ever deeper integration is giving way to a patchwork of competing blocs, and that has direct portfolio consequences. Europe's future role hinges on whether it can reform and unify fast enough to remain a strong economic and financial pole, while countries like Canada, Qatar, and Venezuela reposition through new defense and energy partnerships, and Latin America is flagged as a region whose strategic importance is likely to rise. For now, many investors remain structurally long the dollar and U.S. assets even as they gradually diversify, but persistent questions around sanctions, tariffs, and resource access mean that cross-border exposures, commodity pricing in dollars, and safe haven allocations will stay at the heart of risk discussions. Next, we turn to artificial intelligence, which is simultaneously amplifying some of these geopolitical tensions and providing the strongest counterweight through productivity and earnings growth. Artificial intelligence is now central to the macro story, not just a tech sector theme. Recent estimates suggest that AI-related spending on data centers, infrastructure, and energy accounts for nearly 40% of U.S. GDP growth over the past year, and power sector forecasts now point to a doubling of U.S. electricity growth by 2050, driven largely by AI and electrification. Orders for gas turbines at companies like GE Vernova have nearly doubled in a year to around 80 gigawatts of backlog, with hyperscale data center operators expected to represent roughly a quarter of that order book by 2026, underscoring how deeply AI demand is reshaping industrial capex. Beneath the macro numbers, there is now a dense layer of concrete enterprise use cases that give this cycle more substance than past tech booms. Pepsi is rolling AI tools out to around 125,000 salespeople. FedEx reports hundreds of millions of dollars in new business from AI-driven customer targeting, and Meta cites advertisers earning over $4.50 of revenue for every dollar spent when using its AI-powered ad tools. Over 1 million businesses are building on OpenAI's platform. Enterprise revenues, they're catching up quickly to consumer, and other providers such as Anthropic report internal targets, moving from 100 million toward potentially 1 billion, and even $10 billion within just a couple of years, highlighting the strength of early demand. The AI race is also explicitly geopolitical. China is accelerating energy infrastructure investments to support its own AI sector, and models like DeepSeek are advancing even without access to leading U.S. chips. While more companies in Europe and elsewhere consider Chinese AI solutions as alternatives to U.S. offerings. At the same time, the U.S. is tightening export controls and sees little value in shipping older chips to China, and domestic regulation is fragmenting, with over 1,000 state-level AI bills proposed, creating heavier compliance burdens that large platforms can absorb more easily than smaller competitors. For markets, the tension is between very real economic impact and clear signs of froth. U.S. tech, especially AI leaders, trade on elevated valuations, and some investors describe current pricing as bubble-like, with a coming wave of AI IPOs over the next 6 to 12 months seen as a classic marker of late-cycle enthusiasm. Funding structures around certain model providers rely on a tight loop between customers, partners, and investors, which raises questions about systemic vulnerability if any key node stumbles, while power affordability and grid constraints threaten to slow scaling just as capital spending peaks. The macro stakes are high because AI-driven productivity could make today's fiscal and valuation metrics look far more comfortable, but only if the gains are large and widely shared. If automation and decision support genuinely raise trend growth, they could help manage heavy public debt loads, keep inflation contained, and justify high multiples, especially in enterprise software and infrastructure tied to AI. However, if adoption proves slower, or if benefits accrue mainly to a narrow group of incumbents, the world could instead face persistent inflation, sluggish growth, and rising political stress from job losses and inequality, with the sector then repriced from growth engine to source of volatility. Looking ahead, markets are likely to focus on a few pivot points in AI. One is evidence in corporate earnings that AI is lifting revenues or margins beyond the tech sector. Another is how regulators balance innovation against safety after high-profile incidents and mounting calls to update legal shields. And a third is how quickly grids, gas capacity, and renewables can scale to meet surging demand from data centers. Despite fears of an eventual bust, most observers expect AI to generate substantial economic value over time, with the main uncertainty being which layer of the stack model providers, ecosystem innovators, or end users captures the bulk of it. That uncertainty feeds directly into how investors think about growth more broadly, which brings us to the surprisingly strong macro backdrop. The growth backdrop, especially in the United States, looks stronger than many expected only a few months ago. Recent data point to core inflation running at about 1.6% over the past 3 months, while fourth quarter GDP is tracking near 5.4%, a combination of robust activity and moderating price pressures. The economy is now growing at roughly double the pace that international institutions projected last April, and private forecasters have lifted their 2026 expectations toward 2.5% with risk seen on the upside, helping to support a constructive earnings narrative. Corporate results reflect that momentum. Large-cap U.S. earnings are estimated to grow between 15 and 17% this year, well above long-term averages, while broader U.S. earnings grew about 8% in the prior year with expectations for mid-teens gains ahead. Investors have committed around $18 trillion in new U.S. investments since the election, on track to approach $20 trillion, and equity leadership has broadened, with all 11 S&P sectors recently in positive territory and more than 80% of stocks advancing on some days, alongside renewed strength in small caps. Outside the U.S., the picture is more mixed but still offers notable bright spots that matter for global portfolios. Germany's ramp-up in defense and infrastructure spending is expected to lift its growth rate to around 0.9% in 2026. Qatar is locking in long-term LNG contracts with Germany and France while pursuing diversification beyond energy, and Canada is raising defense budgets and courting manufacturing and energy investment with a particular eye on the Arctic. In the Middle East and Eastern Europe, a sustained ceasefire could allow Israel to grow around 5% next year, while a durable peace in Ukraine is seen as a catalyst that could potentially triple its GDP over a decade, turning reconstruction into a secular investment theme. Sector stories give additional texture to this growth phase. Airlines such as United and Delta report strong demand from both international and domestic travelers with upbeat guidance into 2026. Luxury names like Burberry and LVMH are outperforming European indices on signs of a Chinese consumer rebound, and platforms such as Netflix, Gap, and senior housing real estate are all citing solid revenue and cash flow expansion. In credit, private lenders like Churchill Asset Management are raising record sums, with direct lending deal activity up around 80% year-on-year, and global M&A volumes have risen roughly 40% as companies use healthier equity currencies and improving financing conditions to pursue growth. Policy and valuation debates sit on top of this growth story. Despite large budget deficits, there is little immediate concern about U.S. sovereign stress, and some policymakers argue that strong growth is not inherently inflationary, signaling a willingness to tolerate higher GDP without reflexive rate hikes, which supports risk sentiment. At the same time, growth is uneven, concentrated in AI-related sectors and higher-income consumers. Europe faces worries over declining living standards and military capacity, and trade tensions or a setback in AI productivity could quickly challenge today's optimistic earnings paths. From a cross-asset perspective, the key watchpoints now are whether earnings breadth persists, how central banks respond to continued upside data, and whether geopolitical shocks or valuation concerns trigger the deeper correction that some investors believe is needed before the next leg higher in the cycle. To wrap up, markets are juggling three powerful forces: a more fragmented geopolitical landscape, an AI cycle that is delivering real growth but also valuation and policy risks, and a macro backdrop led by a remarkably strong U.S. economy with improving earnings breadth. How tariffs around Greenland evolve, whether AI productivity shows up more visibly in earnings, and if central banks stay comfortable with robust growth will shape volatility, sector leadership, and cross-border capital flows from here. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.